Hello and welcome to this new episode of Benchmarks in Transition. In this episode we will look at why we need a transition. For the last 30 years the system was working quite fine. Why do we need to change it now? Enjoy!
Why do we need a transition? That's an important question to answer before we do the actual transition. For that, we have to look at where we arrive there. So LIBOR, for example, was originally developed by the British Banker Association and was launched in 1986. And the question underlying LIBOR was, at what rate could you borrow funds were you to do so by asking for and then accepting interbanks offers in a reasonable market size just prior 11 a.m. So this benchmark was created by the banks, by the British Banker Association, and for the banks. It was measuring the interbank offers. It serves the need of the banks. Again, that's why it was created, not necessarily the use of the end users. But then this benchmark was used for many purposes. Maybe not because it was the best measuring device, but because it was available. In particular, it was used for monetary policy, for retail products, for corporate bonds issuance. And if we look at monetary policy, the same central banks and regulators that today are pushing for the end of LIBOR, if you look back 5 years or 10 years ago, when you look at their description of their monetary policy, LIBOR, the rates of LIBOR, was one measurement, one way to measure the success of their monetary policy. So the same people that today want to get away from LIBOR were pushing for it, at least indirectly, in the past. One thing that happened with LIBOR is manipulations. To improve their P&L of their daily trading activities, some banks have changed their submission of rates a little bit lower, a little bit higher by 1 basis point, 2 basis points to improve their P&L. Why was it possible? For that, we go back to the definition of LIBOR, which is very conditional. At what rate could you borrow funds? Were you to do so by asking, and so on. So it was not an actual measurement of an actual transaction. It was the estimation by someone of where someone else will offer the rate. So this opened the door to manipulation, and those manipulations happened. And we know that they happened because there were some court decisions about it, and banks have paid heavy fines for it. So roughly $6 billion of fines have been paid, starting in 2012 with Barclays, and then a lot of other banks and brokers have had to pay different fines. Another way LIBOR was manipulated is to hide credit concerns. Why? During the crisis, the submission of each bank to the LIBOR panel was published. So it means that the public in general could see what was the level at which banks could borrow, and if banks in trouble were showing their true cost of borrowing, they will show the trouble in which they were. So there was the interest by some people to hide their credit concerns. Unfortunately, we will never know exactly what happened there. Those investigations about this hiding credit concerns at a wide level have been unexpectedly closed in October 2019, so we will never know exactly who was part of that and what happened there. But what we are sure of is that this LIBOR was manipulated, and because it was possible, its definition was quite weak, and it was of the interest of the panel to do so. So that was one of the reasons, or is one of the reasons, why we are transitioning. Another one is visible in the graphs on the screen. So this graph represents numbers of notional of interbank borrowing or interbank lending. This is from the US Federal Reserve, and it is borrowing in the US market. So LIBOR is London, so it's in London. These numbers are in the US, but they measure the same thing. So if you look at the notional that was exchange borrowed in the 80s when LIBOR was created, so it was created in January 1986, you see roughly the level of interbank borrowing was at that time 100 billions, but for the moment I'm interested by relative level, let's say 100. And if I move the dates and I look now at the time of the crisis, or at least just before the crisis, the level was around 500. So a lot of interbank borrowing. Now, a couple of years later, so let's say 10 years later, if you look at what is happening there on the right side of the graph, the level of borrowing, or the notional, is reduced to less than 100. So the amount borrowed interbank for a term rate unsecured has decreased fivefold during this period, the last 10 years. So roughly now people say that LIBOR is essentially measuring the rate at which banks are not borrowing for each other. Not borrowing for unsecured for a term does not mean that there is no money exchange, no borrowing at all. And this is explained by the next graph. It contains two curves. So first, the time horizon is a lot shorter. It's from 2007 to today. And if I look again at what happened just before the crisis, and I look at the red curve, the red represents the effective Fed fund rates, so which is the lending between large banks on the Fed account. So it's between the banks. The Fed is just the place where where the borrowing takes place, but it's not borrowing from the Fed, it's borrowing from one bank to the other, and it is unsecured. So the level was roughly 125, again, billion before the crisis. After the crisis, if you look at 2012, 2013, those amounts reduced dramatically, down to something like 30 billion. And now, on the right of the graph, you see it's around 75 billion. Now, if we go at the top side of the same graph, what we have is the another part of the market, the lending. This is described by SOFR, Secured Overnight Financing Rate. The important part there is secured. So this is the volume of lending. It is not interbank only. It includes also other financial institutions, money market funds, insurance, hedge funds, and so on. But it is overnight and secured. Where you see there the notional, it goes up to well above 1,000 billion, so 1 trillion a day. So there is still huge amount borrowed, is borrowed in a different way. So that's another reason why the transition is required. The market, the underlying borrowing market has changed. But if we look at the derivative side, so up to now we have looked at the underlying, the cash borrowing market. If you look at the derivative market based on those benchmarks, or the LIBOR or the overnight, you see huge amounts. So that's on the screen. It's the outstanding amount of vanilla swaps at different CCPs. If you take LCH, it's 377 trillion, CME 19, Eurex 17. Those numbers are huge, well above what is what the underlying market is. That's what is outstanding. If you look at what happened in the last years, let's say, or even this year, in the last couple of months, and there I've put the amounts traded at LCH since the beginning of the year. It's 380 trillion that have been transacted at LCH. Around 200 of them are derivative based on LIBOR or IBOR in general, and around 175 based on overnight benchmarks. That means around 25 trillion a week is traded on the derivative side. 25 trillions, that's roughly the level of the capitalization of the S&P 500. It was 25 or almost 25 a month ago, and also the level of the US debt, again, 1 month ago. So it means the derivative side is still huge and growing and well beyond the underlying market. So we are basing this this big derivative market on a small underlying. That is very dangerous, and that's one of the reasons why the transition is required. On the transition side, that's the timetable. As mentioned, 1986 was the creation of LIBOR. It worked for 30 years or so. We saw manipulation around 2000 to 2010. There was in the UK the Weekly Report in 2012, looking at LIBOR, and at the international side, the Financial Stability Board, FSB, published a paper in July 2014 describing the necessity to reform interest rate benchmark. From there, many benchmarks have moved. So in 2017, in the sterling market, the preferred new benchmark was decided, SONIA. In the dollar market, 2017 also, the new preferred benchmark, SOFR, was designated, and SOFR has been published since 2018. September 18, in the euro side, the new preferred benchmark, Euro STR, and then a long list of consultation on the fallback. Those consultations will be discussed in a forthcoming episode of this series, but they were in October, November 18, May 19, September 19, October 19, different consultation. And then in the euro side, the first Euro STR rates were published in October 2019. Today, we still have one consultation in progress around fallback. That was the past. Let's look at the future. The first thing that will happen, or one of the things that will happen soon, is the new ISDA definition for fallback provisions. Then on the overnight rate side, in June 20 on the euro side, October 20 on the dollar side, there will be the CCP discounting Big Bang. Again, that will be described in details in one of the episodes. Once the CCP have changed, probably a lot of people bilaterally will change also. There are plenty of question marks on that line because it's up to the different people to decide when they want to do it. And then we arrive at the end of 2021, where there is some kind of hard deadline. The agreement between the FCA and the LIBOR panel finish in end of 21. The transition period for euro benchmark regulation is also ending there. EONIA will stop to be published there. So this is three things that happen roughly at the same time that will force the transition to take place before those dates. There is probably a little bit of freedom to change some of the dates, but essentially this is the deadline for all those transitions.